Spotify, the audio subscription company, has done a great job adding millions of new subscribers to both its free service plan and its premium paid service plan. A lot of investors are curious about Spotify stock and want to know what's a fair price to pay for this business? What's a fair price to buy the stock? That's a question I'm going to answer in this video by conducting a discounted cash flow valuation of Spotify stock. So let's jump into the details. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so what you see here is a discounted cash flow valuation model for Spotify stock. And before we dive into the details, let me let you know that there's been many estimates and assumptions used to create this financial forecast. And so the valuation can change drastically if I were to change a few inputs up or down by only 1 percentage point. And so these are not precise calculations. These are to be taken with a margin of safety, which I will also talk about a little bit later. But let's start with the Wall Street Analyst of free cash flow, which is here on the top left-hand side. So the numbers you see here from 2024 to 2028 are derived from Wall Street Analyst estimates that are following Spotify stock. They delivered their forecast for what they think this company's free cash flow will be over these next few years. And the source which I got the numbers from are ticker.com. And so they collect those Wall Street Analyst estimates, and these are the midpoints of those estimates. So those analysts expect its free cash flow to grow from $2.18 billion in 2024 all the way up to $4.63 billion in 2028. So they expect the company's free cash flow to more than double over the next few years. That's a short-term growth rate of free cash flow at about 21%. From 2029 to 2034, I forecast its cash flow using my own rate, and my projection is that its free cash flow will grow at 10.65% per year from 2029 to 2034, increasing its free cash flow from $5.1 billion to $8.5 billion in 2024. And you may have noticed my forecast for free cash flow growth over those years is slower than its growth from 2024 to 2028. That's typically what happens with corporations as they get larger. Their rate of increase tends to slow down. The rate of increase tends to slow down, even if the absolute number of cash flow increases. As you can see here, from $5.1 billion to $8.5, that's a $3.4 billion increase in free cash flow compared to 2024 to 2028, which is only a $2.5 billion increase in free cash flow. So the total free cash flow increases at a faster, but the rate of increase slows down. Then from 2035 onward, I forecast the company's free cash flow will grow at a 5% long-term growth rate. And the reason I use 5%, I get asked this question a lot. Why do you use 5% when economic growth is only expected to be 3%? And the reason has to do with inflation. Economic growth is expected to be 3% if you're looking at real growth, which is adjusted for inflation. I'm not adjusting my forecast for inflation. I'm looking at these numbers nominally because we look at the stock price nominally, right? We're not adjusting the stock price for inflation. So I'm not adjusting my free cash flow forecasts for inflation. I expect developed economies worldwide will grow at roughly 5% nominally between 2035 and infinity. That's where I believe the equilibrium growth rate is for developed economies nominally over the longer term. And so we forecast all of the company's free cash flows between 2024 and infinity. The free cash flow from 2035 onward, instead of calculating each year individually, I use the terminal value shortcut, which takes the free cash flow 1 year ahead, divided by the weighted average cost of capital minus the growth rate. This is actually a question on my midterm exams that I teach at university. Students are expected to know this formula, how to calculate this value, and how to interpret the answer from this value. So all of these cash flows, if you combine them all together from 2034 to infinity, the value of those present value of those cash flows totaled $57.9 billion. And the key word I use there is the present value of those cash flows. Because these are cash flows expected in the future, when we try to find the value of those cash flows today, we need to have a discount rate applied because money in the future is not worth as much as money today. And that discount rate I applied is the weighted average cost of capital. And for Spotify, I calculated that at 13.2%. I applied a cost of debt of 7.5%, and my capital asset pricing model cost of equity came to 13.86%. The company has a beta of 1.56. I applied a risk-free rate of 4.5% and a market risk premium of 6%. Since the company's market cap is $103 billion and it only has $1.8 billion in debt, I gave them a target capital structure of 10% debt and 90% equity. That brought me to the calculation, the weighted average cost of capital of 13.22%. The reason it's called the weighted average cost of capital is because you have two capital sources here, debt and equity, and you have a percentage allocated to each capital source. That's the 10% and 90%. And so you take the cost of equity multiplied by the percentage of equity plus the cost of debt multiplied by the percentage of debt to arrive at the weighted average cost of capital, which came to 13.22%. That's the discount rate I apply to all of the cash flows that's generated by Spotify. And so now if we come to the value of operations, $57.9 billion, we need to add the cash balance of $6.1 billion, subtract the debt of $1.8 billion, and that brings us to a value of equity of $62.2 billion. But we want to know the price per share, so we divide by the number of shares outstanding at 207.4 million, and that brings us to an intrinsic value per share of $300 for Spotify. Now the current market price is $508, so this calculation would suggest that Spotify stock is overvalued. Even if I apply a margin of safety here of, let's say, 10%, that would bring the value between 450 to 550, and the intrinsic value of 300 is still above that or below that range. Now, this doesn't mean that you should sell Spotify stock because the price is going to go down. This just means that's my calculation for what I feel Spotify stock is worth today. The whole market might disagree with me, and so the price may remain above my intrinsic value calculation forever. It's just my own personal calculation for what I feel these shares are worth. And so I encourage you all not to just follow this price, but to do your own due diligence and come to a conclusion on your own of what you think Spotify stock is worth. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.